Hello everybody. In today's video call we are going to discuss three topics. The first one, the MSCI World ex-USA compared to the MSCI USA. So we'll see that the World ex-USA started to underperform again the US market, which is exactly the opposite of what we saw during the late January sell-off. Then I will talk about the Euro Stoxx 50 because this index made what we call a death cross. So I will discuss this topic in a few minutes. Then we will end with an update on European sectors because I noticed a significant sector rotation since 1 or 2 weeks towards defensives, which is quite interesting in the short term. So let's start with the MSCI World ex-USA. What you can see here is that the MSCI World ex-USA remains in a long-term uptrend, made a setback in February on its 200-day moving average, another setback on this moving average at the end of last week. Each time we saw a technical bounce showing that investors are still buying the dips. However, what I noticed is that during the recent recovery, the 50-day moving average was a clear resistance, which makes me think that the risk of further decline below this 200-day moving average is quite high, let's say within coming weeks or even months. What reinforces this cautious view in the short term is what we noticed on the relative chart MSCI World ex-USA versus USA. So as a reminder, the US market underperformed the rest of the world during the late January sell-off, but since then it seems that people are coming back on the US market and unloading the rest of the world. So you can see that World ex-USA is starting to underperform again since a couple of weeks, and the relative chart is moving back to multi-year lows and even breaking below the lows we made in late 2016, early 2017. So obviously from a technical point of view, this relative chart is deteriorating again, and that's a bit concerning from a technical perspective right now. If we switch now to Europe, the technical outlook is relatively mixed right now. The good news is that we had two technical bounces on a Fibonacci support. So first one after the late January sell-off, and the second one last week. So this Fibonacci support is 33.15. So two technical bounces, you can see that. But the bad news is that we just had a bearish crossover between the 50 and the 200-day moving averages, which is called a death cross, and shows that the medium-term momentum is obviously deteriorating. So in the medium term, it's not good news, and it shows that even if the market continues to recover in the short term, I think that we should encounter resistance around this 200-day moving average, which is, by the way, turning downwards now. The slope is negative, and this moving average is now trading around 35.30. As you can see, the opposite signal, so the bullish signal, bullish crossover, was here in late 2016, and it was pretty successful. So I see this bearish crossover as a warning for the European market in the medium term. If we look at the previous signals, so I will show you 4 signals. So we had 2 signals in 2015 and also 2014. So one signal here, which was close to a market low. So the market hit a low a few weeks after the signal, then rebounded. But as you can see here, the 200-day moving average provided resistance during these technical bounces. Then the market started a big sell-off again in 2016. If we analyze the signal which occurred in late 2014, we can see that this time the sell signal was close to the low, near the end of the correction. However, it took almost 3 months before the signal was clearly invalidated and the market moved up again. Two more signals, one in 2012. Once again, this signal occurred near the low of the market, so pretty bad signal, and it took a couple of months before resuming the uptrend. A very good signal in 2011, as you can see here. Once again, a sell signal near a low, then a technical bounce. Once again, the 200-day moving average provided resistance, and the market declined pretty sharply just after that. So, conclusion of this analysis is that in half of the cases the signal is very bad, and in half of the cases the signal can be very good. Most of the time what happens is that when you have this death cross, the market bounces back, which is probably what we are seeing right now. Then after that you have a 50-50 case. In half of the cases the market whipsaws, but does not hit new lows and breaks out within coming months. But when the 200-day moving average is providing resistance, there is a risk of seeing another leg down and the market resuming its downtrend. So right now the situation is pretty critical and will probably stay critical in coming months. A quick focus to end this presentation on European sectors. So here is my matrix. So you find this matrix every Monday in my weekly sector report. You can see here that a lot of defensive sectors are starting to improve in the matrix. The best sectors are becoming real estate and media. That's where we are seeing the strongest technical bounces, and also start of short-term technical bounce of food and beverage, healthcare, and we can also that telecom and utilities are making a slight comeback, although they remain in amongst underperformer. On the opposite, we are starting to see profit taking on basic resources, also auto, which is weakening a bit, and banks. So the market is slowly turning back into defensive, which were sold heavily over the last years. It's too early to call for a major trend reversal, but that's obviously something quite interesting to monitor. Within cyclicals that remains pretty strong, technically speaking, we can notice that chemicals the relative chart against Stoxx 600 is holding above an important support zone. So this remains a pretty good sector, and the technology is very strong. The relative chart hit new highs this week. So the recent correction obviously did not endanger the leadership of the European tech sector. I mentioned you real estate as an interesting defensive sector. So as you can see here, real estate has been forming a base since last year. The sector is starting to outperform after making some whipsaws. I think it should be able to reach the upper part of this trading range and maybe break out in the medium term. So that's something to monitor in the medium term. And on the opposite, one very weak cyclical sector, construction and materials, I still favor in a downside break on this sector. Thank you very much for listening, and have a great weekend.